Hey everyone, and welcome to This Explainer. If you've ever felt like there's some hidden language to global finance that nobody is translating for you, well, you're absolutely in the right place. Today, we're diving straight into a masterclass on the structural mechanics of modern money systems and institutional wealth architecture. We're going to open the hood and look at the exact blueprints used by elite capital allocators.
So, right off the bat, how do elite institutions actually build wealth? To figure that out, we have to completely discard generic retail advice. We're mapping out the sovereign-level blueprint today. Elite finance isn't about motivational slogans or clipping coupons. Not at all. It operates with intense mathematical rigor, macro-level thinking, and first principles reasoning. To truly understand these economic power systems, we've got to look past all the surface-level noise and examine the deep structural reality of how capital actually flows.
Because, let's be real, there's a massive gap between mainstream misunderstandings and the precise quantitative reality required to build actual wealth. The retail mindset, it relies on emotional narratives, popular myths, and generic budgeting rules. But objective reality, the way billionaires, private equity firms, and sovereign wealth funds operate, is a totally different ballgame. They rely on legal structural realism and systems-level causal analysis. They don't just play the game or blindly participate in the market, they literally architect their exposure to it.
Here is our roadmap for today's explainer. We're going to systematically unpack the 4 pillars of financial power: financial language, legal structures, capital allocation, and macroeconomic liquidity. Then, we'll synthesize the whole shebang into one cohesive system.
All right, let's jump right into Pillar 1, financial language, which is really the core architecture of wealth.
Now, I know what you might be thinking. Accounting sounds incredibly boring, just static numbers on a spreadsheet, right? But thinking that way is a critical mistake. Accounting is actually a symbolic compression of economic reality. It's the language of business and power. Elite institutions don't just stare at static numbers. They're reading the underlying managerial incentives, the strict legal obligations, and the true cash realities hidden just beneath the surface. When you learn to read an income statement this way, it stops being basic math and starts becoming a dynamic map of human behavior and corporate strategy.
The crucial takeaway here is that you absolutely must master these specific concepts to bridge the gap between reported rules and true earnings quality. Take the accrual illusion, for example. Under accrual accounting, a company can look amazingly profitable on paper while simultaneously bleeding cash in reality. It happens all the time. You've got to understand balance sheet forensics, working capital dynamics, and non-cash frictions like depreciation. Institutional allocators strip away all those accounting distortions to find one thing: pure, unadulterated free cash flow. That is the only metric that truly matters when you're evaluating the financial lifeblood of any entity.
Moving right along to Pillar 2, legal structures, which essentially dictate the rules of the game.
Here's something really fascinating. Capital strictly flows through the pipes built by lawyers. Structural barriers, property rights, and tax shields dictate exactly where money settles and who absorbs the risk. Elite wealth is almost never held directly. It's highly structured. Whether we're talking about an LLC, a C Corp, or a massive holding company with a dozen subsidiaries, these frameworks are explicitly designed for ring-fencing risk and jurisdictional arbitrage. They establish the fiduciary duties and liability shields that protect capital from being completely destroyed by litigation or taxes. It's the literal legal architecture of wealth preservation.
And understanding this legal seniority is absolutely mandatory. We call this the capital stack. Up at the very top, you have senior secured debt, followed by unsecured debt, subordinated debt, and finally, all the way down at the bottom, true equity. So why does this hierarchy matter? Well, in the event of a bankruptcy or a Chapter 11 restructuring, this stack dictates exactly who gets paid and who gets totally wiped out. The folks at the top have secured legal claims on the assets. The equity holders at the bottom, they absorb the maximum risk. Elite investors always know exactly where they sit in the stack. No exceptions.
Okay, let's pivot to Pillar 3, capital allocation, or how this power is actually deployed.
Capital allocation isn't about guessing what a stock is going to do tomorrow. Honestly, that's a fool's errand. Valuation is an absolute discipline, but it operates in a highly probabilistic environment. Elite allocators use strict, rigorous mathematical frameworks, things like discounted cash flow modeling, the time value of money, and opportunity cost mathematics, to aggressively price risk and extract alpha. They're calculating the intrinsic value of an asset with a massive margin of safety, constantly weighing risk versus return.
To actually deploy this wealth, allocators use specific vehicles that perfectly balance modern portfolio theory with real-world leverage.
You've got equities, which are driven by factor investing like value or momentum. You've got fixed income, or mechanics like yield to maturity and duration are king. Then there's real estate, evaluated through cap rates and depreciation shields. And finally, alternative assets like private equity and leveraged buyouts, where leverage is used specifically to juice up the IRR. True institutional wealth relies on mastering the granular mechanics inside each of these distinct vehicles.
Now, zooming way out, we enter Pillar 4, macroeconomic liquidity.
Think of individual assets as mere boats on a vast macroeconomic tide. To understand today's markets, you really have to trace the historical timeline of our global plumbing. We're talking about the creation of the Federal Reserve in 1913, the Bretton Woods Agreement in 1944, the Nixon shock in 1971, which, as you know, fundamentally decoupled our money from gold, and of course, the 2008 global financial crisis, which launched the era of quantitative easing. These aren't just historical trivia points. They're the massive architectural shifts that literally built the modern debt supercycle we are all navigating today.
These macroeconomic forces dictate global capital flows, straight up driving the continuous cycles of inflation, deflation, and financial crises. The market is propelled by central banking operations, fractional reserve money creation, and huge, invisible offshore networks like the Eurodollar system. By treating the yield curve as a macroeconomic oracle and deeply understanding the anatomy of credit cycles, elite strategists can anticipate liquidity spirals and massive margin calls way before they ever hit the evening news.
All right, let's bring it all together for our final section: systems thinking and synthesis.
This is where the magic happens. True institutional dominance requires seeing way past first-order effects to anticipate the second-order systemic feedback loops and unintended consequences that actually trigger market collapses. First-order thinking, that just looks at immediate cash flows and expected yields. Anyone can do that. But playing at the elite level requires mapping out the reflexive feedback loops, asking what breaks under extreme stress, identifying hidden fragilities, and tracking contagion pathways. It's about seeing how the accounting, the legal wrappers, the asset valuations, and the macro liquidity all dynamically interact with each other in real time, like a giant puzzle.
So if you take only one thing away from this explainer, I want it to be this core mental model right here. Debt is controlled time arbitrage. Actually, I want you to really let that sink in for a second. Elite finance is ultimately about structurally controlling time, risk, and legal reality. It is a completely interlocking system designed to preserve and compound power through absolute mathematical rigor and structural asymmetry.
You now hold the foundational blueprint of financial power. You've seen exactly how accounting, law, valuation, and macro liquidity interlock to preserve massive wealth. But having structural knowledge is really just the beginning of the journey. The real question is, now that you can clearly see the matrix of global finance, how will you choose to navigate it?